Ladies and gentlemen,
Ladies and
good day
gentlemen,
and welcome to
good
the
day and
V2
welcome
Retail
to the
Limited
VIL
Q2 and
Engineers
H1
India Limited
FY26
Q2
conference call
FY26
hosted by
earnings
Marathon
conference
Capital.
call
As a
hosted
reminder,
by
all
DAM
participant
Capital
lines will
Advisors
be in the
Limited.
listen-only mode
As
and
a
there will be an
reminder,
opportunity for you
all
to ask
participant
questions
lines
after the
will be in the
presentation
listen-only
concludes.
mode and there will be
Should
an
you need
opportunity
assistance
for you
during
to
this
ask
conference
questions
call, please signal
after
an
the
operator by
presentation
pressing star
concludes.
then zero
Should
on
you
your
need
touchtone
assistance
phone.
during the
Before we
conference call,
begin, a brief
please
disclaimer.
signal an operator
The
by
presentation which
pressing star
V2
then
Retail
zero
Limited
on
has
your
uploaded on the
touchtone
stock
phone.
exchange and their
Please note
website,
that this
including
conference
the
is being
discussion
recorded.
during this call,
I now hand the
contains or may
conference
contain
over to Ms.
certain
Bhumika
forward-looking
Nair.
statements
Thank you,
concerning
and
V2
over to you,
Retail
ma'am.
Limited business, prospects, and
Yeah, hi.
profitability,
Good evening,
which are
everyone.
subject to
On
several
behalf
risks
of DAM
and
Capital, I
uncertainties,
welcome you to
and the
Q2
actual results
FY26
could materially
earnings
differ
call
from
of
those in
Engineers
such
India
forward-looking
Limited.
statements.
We have the
I
call
now
today
hand the
being
conference over
represented
to
by Mr. Sanjay
Mr.
Jindal,
Akash Agarwal,
Director
Director
Finance,
and CEO of
Mr.
V2
Surendu
Retail.
Padhi,
Thank
Company
you,
Secretary
and
and
over to
Investor
you, sir.
Relations, Mr. R.P. Batra,
Good morning,
Executive Director
everyone,
Finance
and a very
Accounts,
warm welcome to V2
Mr.
Retail's
Amanpreet
Quarter
Singh
2
Bhutta,
and the
Senior
first
General
half of
Manager,
FY26
AMD Office and
earnings
IR,
conference call.
Mr. Vivek
We trust you've had the
Singh, Senior
opportunity
General
to
Manager,
review our
Marketing,
results.
BD and IR,
The earnings
and
presentation and
Neha
press
Nanda,
release
Senior
are
Manager,
available on the
Company
stock
Secretary,
exchanges
Risk
and
and
also on
IR.
our company's
At this
website.
point, I'll hand
We are
over the
very
floor to
pleased to
Mr.
report a
Jindal
very
for his
robust
initial
performance
remarks, post which we'll
for
open
the
up the
second
floor
quarter
for
of
Q&A.
FY26,
Thank you and over to you,
reflecting
sir.
the strong momentum across our
Thank
business.
you, Ms. Bhumika.
With 86% year-on-year
Good evening,
revenue growth,
everybody,
we
and a warm
continue to
welcome to all the
substantially
investors
outpace
who
the
are
broader market
attending the investor
while
call.
demonstrating the
We
scalability,
have declared
resilience,
our financial
and
results for the
execution
second
strength
quarter
of our
ended
operating model,
30th
even on a high
September
comparison base.
2025.
FY25 laid a very
Our
solid
order book
foundation,
status is
and our encouraging performance in the first half of FY26 further reinforces our confidence in delivering sustained growth and long-term value creation.
131
Innovation, flawless execution, and unwavering customer trust continue to be the heart of our strategy, and we remain deeply committed to strengthening these pillars as we scale. At the core of our success is our highly skilled and passionate team of designers, merchandisers, and inventory specialists. Their ability to anticipate trends, curate targeted assortments, and manage inventory with precision enables us to remain agile, customer-focused, and operationally strong in a rapidly evolving retail environment. We are encouraged by a strong customer response to our distinctive and competitively priced product portfolio. By consistently offering fresh, trend-aligned assortments rooted in quality and value, we are driving broad-based and sustainable growth across our expanding store network. Our strategic expansion into underserved rural markets, combined with deeper penetration in Tier 1 and Tier 2 cities, is helping us build a large and demographically diverse customer base. Our deep understanding of regional preferences, reflected through localized assortments and personalized in-store experiences, continues to strengthen our competitive edge. Now, moving on to some key updates. Let me take you to the key highlights of our performance. So, revenue for the second quarter grew 86% year-on-year to 708.6 crores. We opened 43 new stores during this quarter and achieved a net addition of 70 new stores in the first half of the financial year, taking our total store count to 259 stores with 28 lakh square feet of retail space. Additionally, we have added 16 net new stores so far in the current quarter, taking the total of 275 stores as of today. Reported SSSG for quarter 2 stood at 23.4%, and normalized SSSG adjusted for the Durga Puja shift from quarter 3 to quarter 2 stood at 10.3%. The same-store sales growth for the first 6 months of the financial year stood at 13.3%. We recorded a 58% volume growth in the second quarter of FY26, with full price sales contributing 92%. Our ROE continues to show consistent improvement, standing at 22.9% in the first half of this year, reflecting disciplined capital allocation and strong operational leverage. While we fully comply with the relevant accounting standards for statutory reporting, the economics of retail operations differ significantly. Therefore, it is important to understand how we track internal performance and decision-making metrics. True store level profitability can only be measured when rent is included at the EBITDA level and not below EBITDA. Our annual business plans, budgets, cash flows, and store operation metrics are all prepared on a pre-Ind AS basis. All team productivity metrics and incentive structures are aligned to pre-Ind AS numbers. Our revenue and profitability guidance is also communicated on a pre-Ind AS basis. Given this, I will now share our pre-Ind AS performance for this quarter and the first 6 months of the year. Revenue grew 86% year-on-year to 708.6 crore rupees. Gross margin grew from 27.2% to 28% from the corresponding quarter last year. The EBITDA grew from 7.9 crores to 44.4 crores, which is a 465% year-on-year growth in the second quarter. The EBITDA margin grew from 2.1% to 6.3%, and the PAT grew from 70 lakh rupees to 25.3 crore rupees, which is a growth of 3,561%. Now talking about the performance of the first 6 months on the pre-Ind AS basis. The revenue for the first 6 months grew 69% to 1,340.9 crore. Gross margin grew from 28.2% to 28.7%. The EBITDA grew from 40.1 crores to 96.9 crores, which is a growth of 142%. The EBITDA margin grew from 5% to 7.2%. The profit after tax grew from 19.6 crores to 55.9 crores, which is a growth of 185%. We have been consistently sharing pre-Ind AS numbers for improved transparency around operational performance, and we will continue to report these metrics going forward as well.
We take the first
With this,
question
I now
from the
leave
line
the floor
of
open for questions.
Anwani from PL Capital. Please proceed.
Thank you very much, sir. We will now begin the question and answer
for
session.
taking my question.
Anyone who wishes
And,
to ask a question,
congratulations
may press
for
star and one on
very
the
strong
touchtone
execution.
telephone. If you wish to remove yourself from the
So now,
question queue,
my first
you may
question
press
again
star
on
and two.
execution. We
Participants
have
are
already
requested
done
to use handsets
kind of
while asking a question.
33% growth
Ladies and
for
gentlemen,
first
we
half
will
to
wait for a
first half.
moment while the question
And
queue
I
assembles.
recollect you guiding about 20% plus for full year growth. So now are we changing then? That
First question is from the line of Harsh Dubey from LFC Securities.
So
Please
just
go
first
ahead.
thing wanted to understand on the guidance, and second, on the order prospects for next 6 months. We understand that you have won
Yes, sir, you're audible.
international consulting order again.
I just wanted to understand that we are expanding in various
crore.
So what is your plan for the South Indian markets? Like I know that we are present in
So
that
what is the
market.
full year target now, and what are the
But
prospects
our
for
South
orders?
presence is
And
somewhat,
on the execution, are we changing our
we can expand there as well. So what is your take on that, sir? First
For the guidance purpose, in the turnover,
Yeah,
we are
so
giving guidance of
we
25,
entered Karnataka a few years back,
25,
and now we have 18 stores in Karnataka, and it has become one of our core strong markets.
of around 20.
Similarly, we had entered Goa, now we have 2 stores in Goa. And this year we have entered Andhra Pradesh, and we are getting a very good response in that state also. So South is a very big focus market for us, and a good chunk of our future expansion will come from that region.
Just to update you on the business process.
So sir, so you are planning to enter into South Indian markets, like for example in Tamil Nadu as well? Like because it is also like a good market for retail, and there are lots of competitors that are already present.
30,000 crore mark.
So our aspiration is to be a national level retailer. Our aspiration is to be in all the states of India in the next 2 to 3 years. So definitely we will be present in Tamil Nadu as well.
So this year in the consultancy
The second question is that, so if I get it right, so we are mostly on a basis of brick and mortar, right? So what I wanted to understand, are we planning some omni-channels like e-commerce, just like DMart has got DMart ready? Are we planning something in fashion and for our products?
So that's great to hear. So
Yes,
one
we
thing
are,
is that
exploring
you
different
highlighted
technology
1,600 out of
where we can
4,000,
leverage the
40%.
same store inventory
So are we eyeing for
and add another
40%
channel
plus
which is online to
contribution
sell
in
to the customers in that particular
order
city,
inflow, which you're going to have this
so that it doesn't have any additional cost, and we can leverage the existing inventory and cater to more customers. But we haven't found a suitable technology partner yet, but hopefully soon we'll be able to do that.
So sir, any timeline on that?
Right.
Approximately how much time do you expect that would be online?
Second question.
I think it would be in the next financial year.
I was just observing
And
the
so just one last question.
revenue from consultancy overseas,
When we talk
which was
about our
kind of
stores, so how is
85 to
our break
100
even?
crore
So
last year, quarterly run rate.
for our stores to
And
see?
now this year it is about 70 to
So our
75
stores,
crore
our new
quarterly
stores
run rate.
start from around
Despite
750 to 800 rupees per square meter, and the break-even point is around 500 rupees per square meter. So our stores start from the first month itself,
Any particular
and
reason
it breaks even from the first month itself, and it takes about 2 to 3
years
years for a new store to mature.
this year?
So it grows faster than your mature stores, and then it comes back to company days.
So just to clarify, so first of all, 500 is our break-even point. So, within first month itself, we break even, and then the store becomes mature in 2.5 years. Is that right?
Got good order.
Yes.
24-25.
Perfect. Thank you so much, sir, and once again, congratulations.
So that business has started
Thank you.
execution, taking on. So
Thank you.
we are confident.
The next question is from the line of Aditya Bansal from Motilal Oswal. Please go ahead.
Order book in the foreign.
Congratulations for a very strong set of numbers, and thanks for taking my question.
And are we
My
targeting
first
the
question is
similar
around the
50-50
demand
mix,
environment. Like
since
how has been the trends in Diwali and so
turnkey
far in
was
3Q?
very strong
So
this
can you share some
quarter?
light
So
on
what is the mix we are expecting for this year?
I can just say that the momentum is continuing, and we are very happy with the kind of response we're getting both from our old stores and all the newer regions and the newer stores that we opened.
Losses from associates.
And we are meeting our own expectations. So we are very bullish, and we have a very positive outlook for the
I think
future.
H1 basis, the losses has been massive, and on the
And any changes to the store addition guidance after the QIP?
lower because of that.
Like what are the
Very
current
strong
targets?
performance. Just wanted to understand.
So our initial target was 100 stores, 100 new stores, and we've already added 86 this year. So we have actually increased that 100 number to 130 stores. So I think we'll add around 130 stores this year. And if our store operating and profitability matrix, remains robust and as strong as it is, we will open 150 stores next year.
And we are
Our objective is to achieve an ROE of more than 20%.
Third quarter will give profit.
Okay. And lastly, can you talk about the warehouse investments and any investment in the team that you will require for meeting such an accelerated store expansion? Like anything qualitatively?
Thank you so much for answering the questions. All the best.
So to open 150 stores, we would need capex plus inventory investment of around 350 odd
From
crores.
ICICI
And
Securities.
additional warehousing cost would be around 25 to 30 crores.
And congratulations on a very good quarter. So the first question is on the...
This will include the regional warehouses that you were trying to do under spoke model.
Is there any one-off in the... any one-off which we should be aware of?
Thanks, Lord. Thank you.
Thank you.
Sir, I could not understood.
Thank you, sir.
So
The next question is from the line of Ankit from Subhkam Ventures. Please go ahead.
Yeah,
You are saying
one-off.
Hi, Akash. Good morning
and congrats for a set of numbers. The margin on the consultancy, EBIT margin. QIP money which you have recently
Actually, in
raised.
this quarter,
How
we
have
have
been- how you have
profit
used it
segment of
for
38%. But if on the half...
Yeah, so our aim is to be, one of the best paymasters in the industry for our vendors. So we have raised QIP primarily to repay the debt of 135 crores. We are using 165 crores for our working capital and 100 crores for general corporate purpose. So raising capital helps us, achieve both in terms of supporting vendors' ecosystem by providing enough liquidity and also reduce our product costs by availing bill discounting, and also because it is helping us increase our store opening targets.
Mr. Vivek, can you
throw some more light on, by paying your creditors early, what kind of savings you would be making and how profitable would it be for you?
they will have the management approval. And
even today in India, access of capital for MSMEs is still a big challenge. So our vendors, as we are growing, they are growing with us. So they all need in need of working capital. So we get around 1.5 to 2% per month bill discount from them. So that is directly added to the bottom line. If we pay them their bills earlier.
It should be around 900 crore. And will it be booked in this fiscal?
Going forward, your working capital would...
Will it be booked in this fiscal year, the balance phase 2, or next year, next
fiscal? It is by choice.
It should come towards
yes,
the end
so you will see a drop in our creditors and increase in our working capital days.
And we are going to submit the
but it is because but it is as your choice. This is not compulsory.
Yes, because we are paying our vendors earlier, so our average credit days would go down from about 50-55 days to around 30 to 35 days.
Should be awarded.
Okay,
and any other large domestic pipeline order, domestic ordering pipeline which we are looking at in H2
from them,
or F27,
while they supply you the material or any other soft
Andhra refinery which is going on.
Yeah, so V2 becomes their priority. V2 becomes their retailer of choice, and we've already converted about 15 to 20 of our vendors as exclusive vendors to us, and hopefully becoming even better paymasters helps us, get more vendors under this umbrella who are only supplying to us and not supplying to our competitors.
By IOCL, and they are thinking of implementing the various specialty chemical projects. So those are expected.
How is the traction from the new stores which you have opened, especially which you have opened outside your core markets of UP, Bihar, Assam and Odisha? I mean, these are your core markets.
Thank you.
Core markets.
We take the next question from the line of Prateek from IntelSense.
How is
Please
the
proceed.
PSFs and everything there?
Yes, sir. My question was on the
very encouraging numbers here. There are two things here. So first of all, our benchmark for new stores is should be within a 70% range in terms of sales throughput of the old stores. So they are currently at around 72 to 73%. So they are well within the range. And in terms of new regions, so new stores in old regions versus new stores in new regions, the difference is only 2% in terms of per square feet sales. So even in the newer geographies where we have entered, whether it's Maharashtra, whether it's Gujarat, whether it's Rajasthan, whether it's Punjab, all the new stores are already performing at the level of our new stores in the core markets.
We have got the provision reverse of 35.
Okay, and going forward, when you are targeting 130 stores this year and around 150.
And sir, like you said, it's on a piecemeal basis. So is any other amount that is we are expected to receive on this?
Where you already have presence in so many years,
so that will be released in
a
due
mix.
course of
I mean, what will be the mix? I mean, outside these states, how many stores you'll open?
Okay, just sir, one last question. Sir, in our last phone call, we had mentioned that there were several projects which were advanced negotiation stage.
To the next 5 months of the stores that we want to open, because from the day we finalize the store till the day the store opens, it's a period of about 3 to 4 months. So everything depends on the traction that we get. So for example, Karnataka was such a good market for us, and the traction that we got for every new store and old store was very encouraging. That's why now we have 18 stores in Karnataka. So similarly, now we have entered Punjab, Rajasthan, Andhra Pradesh, Chhattisgarh, Haryana. So if we feel any of those markets are showing exceptional numbers, then we will focus more on those markets. But if you want to talk about prima facie, I think 60 to 70% of the stores will be in existing core markets, and 30 to 40% will be in the newer geographies which are performing well.
Diversification in terms of moving away from the oil refinery space and then looking for the hydrogen hydrogen opportunity going ahead. So sir, where are we? Some work was also done
earlier.
So if you
which were
take out,
informed
okay, at the company level, there's only one store that is below break-even point currently, and that is also a store that has opened in the last 3 to 4 months. So we don't judge a store's performance before it has at least passed 1 year of sales. So if we talk about stores that are at least 1 year old, all the stores are EBITDA positive.
A major diversification. With respect to the new areas which we have talked about, like hydrogen हो गया या और coal gasification हो गया और biorefinery हो गया.
Thank you.
Biorefinery, you know that.
The next question is from the line of Palash from Nuvama Wealth.
This
Please
year
go
we
ahead.
have been recently we have been awarded for assignment for coal gasification.
Thank you for the
from the coal to
congratulations on very good set of numbers.
वो हमें अभी मिली है
So my first question is on gross margin. So when will we see gross margin expanding on account of bill discounting?
Various projects of this sort.
So you should start seeing it from the third quarter.
When we look at our capital investment in the
even the growth aggressive growth plans that you have for next,
we have a
let's say for FY26 and FY27, would it be possible that you will be able to achieve 10% kind of pre-Ind AS EBITDA margins by FY28?
And how is the performance there?
We always guide for the same EBITDA margin because we are promising a very healthy growth number, which is more than 50%. So because new stores start at 70% of old stores and it takes time to mature, and we are adding 60-70% new square feet area. So we always guide for the same pre-Ind AS EBITDA margins moving forward. But definitely when the stores mature, when the new stores that you open becomes only 10, 20 or 25% of your area, then the expansion of EBITDA margin should also happen.
That will be coming in the next quarter.
Okay. And so, let's say for next 18 months, is 10% kind of SSSG possible?
Okay.
That is what we target. So, even for mature stores, I think 8 to 10% SSSG is our target.
We are only
and if we do our execution well, if we plan our assortment well, I think it is possible.
For divesting this
Okay. And so, what kind of stores are you planning to add in states of Maharashtra and Gujarat, and how are those two stores performing? Because last time you told us that those stores are doing very well. So, any color on those two states, and what kind of plans you have on store addition front for next, like say FY27?
So already you have
whenever we enter a new geography or a new state, we open 1 to 5 stores there because we believe in collecting a lot of data. And that data that we collect ensures that we build a optimized store model that fits that particular region or that state. So both Gujarat and Maharashtra store, so Gujarat store is doing more than 1,200 rupees per square feet of sales. But again, it is only one store each in both the regions. It's a very small sample size. So until we have 3 to 5 stores there to collect that data to see the performance, it's very hard to comment what will be the future expansion strategy in those states.
We need to factor in that number.
Okay, sir. Yeah, that's it from my side. Thank you for your answers and all the best for the upcoming.
Thank you.
Reversal of provision is a continuous process.
Okay.
Because
Thank you. The next question is from the line of Yash Kothari from CRK EQ Research.
So it's a routine
Please go ahead.
If some of the provisions are
congratulations on a set of results. And just wanted to know, the unit economics of
what is the net
our
of
store
impact?
per
How much
se,
provision we have
like, what's the per store cost depending on the region, if there is a way to, give me that. And also,
reversed on overall basis, I think it is -12.
the margin guidance, after new stores open, like what's the timeline for like certain margins, how they increase in certain areas?
Sometimes it is on negative.
So I'll answer your second question first. So for margin guidance, we guide for the same margin going forward because we are growing fast. So I think we did pre-Ind AS EBITDA margin of 8% last year. So that is our future guidance for the next 2 to 3 years because we are adding so much new area. And definitely there are levers to expand that margin as well. So one is operating leverage by getting the per square feet cost down. One is better sales mix. and better economies of scale in terms of costing that improves our gross margin. And the third is obviously a good SSSG number that increases the per square feet sale at the company level. But I think when we are adding almost 60-70% new area every year, we guide for the same margins going forward. And now answering your first question, so our store economics, so capex required for the store is around 1,100 rupees per square feet, and the inventory required at the company level for that store is around 2,500 rupees per square feet, out of which, so that's around 90 to 100 days of inventory. So half of it is paid for by us, and half is the credit term that we get from our vendors. So total investment per store is around 2.4, 2.5 crores.
We are constantly looking.
And the total cost at the company level is around 190 rupees per square feet.
Cash on book. Okay.
So you can do the calculation.
It is between 900 crores
Any
to
sort
1,000
of funding that we're looking for in the future? I mean, I know obviously the QIP is just happening, but like, if at all, because obviously we are expanding at such a good rate.
Thank you.
So just wanted to know if there is
Before we
any sort
proceed
of
with the
thought
next
process
question,
in that area.
a reminder to the participants,
There are no plans
in order to ask
currently,
a
but again,
question, you may press
our main objective is to get a good ROE, a healthy ROE. And, if we make a business plan, we make our cash flows. So currently there is no plan, but in the future, if we feel that,
Ladies and
we need to raise
in order
money
to ask a
to
question,
open more stores,
you may press
and, all
star
the business
and one
metrics are very
on your
healthy, then
touchtone
we will do
telephone.
it.
Okay. And just to fall back on the point of the unit economics, so how you said there are three
We take
levels
the
that
next
really
question
affect
from the line
how
of S.
the cost for a
Ramesh,
store comes
an
down. So
individual.
since
Please
we
proceed.
have been expanding at such a good rate,
Good evening and thank you
meeting our
very
own
much.
estimates,
Congratulations
is there
on
any
your
sort of economic
So if you look
scale
at
that
the
we are
split
already
between
seeing when it comes
the
to
turnkey
the cost per
and
square
the
foot
consulting
and the things
income.
that you mentioned?
So if your turnkey
Definitely. So
revenue
we've
share
already
higher,
seen our costs
it
come
is a
down
drag on
by
your
6 to 7
margins,
rupees per
like you
square
are talking about
feet.
single digit
If we
margins.
are comparing it year on
As a
year.
strategy,
And there is a
how
lot
do you
of
view the
scope
split between
for it to further come down
the two
as we
revenue streams
increase
from
store
consulting
area.
and turnkey?
Thank you. That's all from my side. All the best.
So,
Thank you.
how do you see your overall
Thank you.
strategic,
The next
objective
question is from
of
the line of
maintaining
Kailash
ROCE for the business
from Nuvama.
based on
Please go
this
ahead.
blend?
Yes, sir. Thank you for the opportunity again. My question was on rental. How is rental cost panning out, and what is the guidance for next year?
Left in LST.
So our average rental per square feet is around 52 rupees per square feet.
In the Indian economy.
And I think we've already signed 80 stores MOUs. So the average of those stores is around 48 rupees per square feet. So our average rentals are actually coming down.
Opportunity in India. In the consultancy.
Okay. So this rental cost would be a big leverage along with gross margin expansion, right? Even if you open new stores.
For the consultancy business. And
I don't understand what you mean by rental cost will be leverage.
Your rental cost has been continuously going down. So that could mean that margin expansion could happen on account of this.
But it's a very significant change. So our rental cost used to be 53 rupees and now it's 52 rupees.
Trying to maintain
so it's a very, very insignificant change.
So basically, you are saying that overall you will be able to sustain your ROCE based on the top line growth and the cash
Thank you. The next question is from the line of Bhaskar from DSC Finance. Please go ahead.
Consultancy gives the bottom line.
Thank you for the opportunity and congratulations to the management on excellent Q2 results. There is an article that was published in EPH and our research also confirms that many senior positions at the organization includes head of merchandising, head of HR, retail, planning, production, sourcing and design. They are currently vacant. The attrition is also very high and the retail head Amit Gupta left only after 15 days. The position is now vacant. The HR head Amit Bagga left after 2 months. The position is also now vacant now. The IT head Pankaj has exited recently. The inventory planning head Pradeep also left in August. Production head left only after 2 months. The sourcing leads Deepak and Pawan, they also left within a year. And the merchandising category head is serving as the current CFO. Can the management confirm the accuracy of these details and explain why so many critical roles are remaining vacant as of now? And clarify how day-to-day operations are being managed, especially given the ongoing concerns about the governance and operational
investments, in Ramagundam Fertilizers.
Yeah, so except head of HR, all the other positions are not vacant. So I think there's a discrepancy in your research. And second, whenever we hire someone new, there's always a probation of 6 months. And we always communicate with them, because a lot of times what happens is the culture with the company doesn't align with the person. So we always tell any new hirings that happen that, the first 6 months is the probation time, because they are getting to know the company is getting to know them. So, and a lot of times those relationships don't work. But if you talk about buying and merchandising, all our core vertical heads, even including the buying and merchandising heads, they all have been with the company for more than 10 years, and they have experience in this industry for more than 20-25 years. So except the head of HR, I think all the other positions are, taken care of. And that is why we, believe in building a very broad-based management where nothing is dependent on one person, and there's always fallbacks, there are always backups. And because we knew we wanted to grow at such a high growth rate, we spent a lot of time building the foundation over the last 3 to 4 years. And, it's a very normal part of business. If you look at attrition at the head office level, I think it is less than 15%, so which is a very, very healthy number. So
we take the next
I don't think it's a very, any cause of concern.
From ICICI Securities, please proceed.
A second question is, while the company has recorded 22% L2L growth in quarter 2, the SPSS figures have shown only 3 to 4% increase for the quarter 2. And there is an increase of 17% in ASP vis-a-vis 13% L2L growth in H1. And the SPSS has regrown. This indicates that the new stores are performing approximately 20% lower than the existing L2L stores. And we are getting benefit of price increase and not the quantity growth. Is our understanding correct?
Your understanding is not correct there also, because our contribution of apparel has been increasing over the last 2 years. So whenever you want to see whether it's an actual price increase, you should only compare ASP of apparel from last year to ASP of apparel now. So that ASP increase is only 3%, because we have increased the contribution of apparel, and apparel ASP is much, much higher than general merchandise. That is why you see this ASP increase.
I think we have guided for broadly 8,000 crore kind of order intake.
Okay, thank you.
Is it fair to assume that PNC will be close to 5,000 crore order inflow for the entire
questions from all participants? Please limit your questions to 2 per person. If you have a follow-up, kindly rejoin the queue. The next question is
order inflow for the entire fiscal year 26. Out of 8,000 crores, how much should be the consultancy order inflow?
Give a rough sense of what would be the last per month for old stores and new stores for the quarter.
Consultancy would be somewhere around 50%.
I don't have that number for the quarter, but I can give you the number for last year. So last year our old stores were at 1,100 rupees per square feet of sale. So the SSSG numbers for this year that you're seeing is down that 1,100 base.
So last year,
and the new stores last year was around 770, 780.
500 crore. So
okay, but roughly the new stores would be doing more than 70%, which is the sort of threshold that we look for.
Understood. And that is the size of orders are, I think, slightly
second thing is, I think last year we were talking about, say, increasing the share of our own design substantially in this upcoming summer season. And the thought was that if we are able to achieve the target at 90% of own design, then it would be a game changer for the company. So I just wanted to know your thoughts on where we are in terms of progress on that.
So we have decided, the model is working so well that we don't want to make a significant change where we break the model, because you shouldn't tweak something too much when it's working well. So what we are doing is we're trying to increase it 5% every season. So our year is broken down into 4 seasons, because we want at least 20% higher throughput in our own design compared to our vendor design in order to increase that.
Right.
So until unless we see that competitive advantage, we won't make a significant increase. So we are, only taking it a gradual increase and increasing it by 5% every season. So I think we moved up from 25% to 35%, and hopefully next year summer it will be around 40-45%.
Anupam Goswami from Third Life. Please proceed.
Thank you.
So, on the consultancy order that we won,
Thank
large
you.
order,
The next
what is our
question is
timeline
from
of
the line of
execution for
Neeraj
that? And
Mansinga
on the
from
whole
White Pine
overall
Investment
order
Management.
book, how
Please
do
go
you
ahead.
take it on the
Thank you for the
margins
opportunity. I
front
just had one question. We have seen it
and the execution timeline for the whole order book as well?
How will this impact your
Typically, any
realization and
bigger
margins
project
for
will
this
have a
quarter?
time schedule of 36 to 48
So,
months.
historically we have seen monsoons don't have a very big impact. So what happens is if there is a...
I'm very sorry.
So this
Instead
turnover
of
would be
monsoon,
divided
winter.
into
The winter also is very
recovery would be
sharp
in 3
this year.
years' time.
Sorry for that.
Yes. So we have seen our, winter contribution increase from about 40% on the last year same day to almost 55%. So that is very healthy for us because winter is, number one, you have extra margin, extra gross margin. Second, the ASP is higher. So it translates into much better sales numbers. So there's a delta of around 5%.
Thank you. We take the next question from the line of Rajesh Agarwal.
EBITDA side?
An individual investor, please proceed.
But how much gross margin is the difference between
How much we have invested in Ramagundam project, and what can be the annualized
So a winter product would have a gross margin of about 34%, and the normal product would have a gross margin of about 31. So the delta is about 3% gross margin.
Is okay. It will generate minimum 500 crore.
Got it. And you are witnessing across the sale, higher sale across
26%.
all these stores, right?
And now things are normalized, so there?
Yes. So winter has been, early onset of winter has been very good for us.
Sir, one question I want to understand on the right back.
Okay, great.
Suppose this quarter we have written back 35 crores. So net pay, how do we understand how much we have
Thank
written
you.
back?
The next question
Some
is
provisions
from the
must have
line
been
of
made for
Shivam,
the
an
other
individual
orders
investor.
also.
Please go ahead.
Actually, we have written back a figure of 35
So
crores.
as we have done a QIP
Actually,
of 4 years, and now there's
as per
payables
contract,
are
provisions
coming
are
down.
being made.
So at least the
And
gross
whenever
margin
our
will be
defect
going up.
liability period is
So
over,
why are we not
we
increasing
reverse
our
the
EBITDA
provision,
margin
for that
guidance from
particular
8 to say like, okay,
So
9 to
in
11?
this quarter, we have
So last year we did a 8% of EBITDA margin.
amount, 35 crore.
Yeah, but
And
if
we
you
have,
look at the impact, so
provisions
even if we
but overall impact is
prepay 100 crores to our vendors, that is
how much?
just 2 crores per month.
12 crores.
So if you look at the impact, it's not a very big impact, and we don't guide for a increased EBITDA margin only because we have already opened 84, 85 new stores this year, and we're opening 130 new stores this year, which will have a per square feet sale which is 70% of all
So
stores.
without reversal,
So that EBITDA margin offsets any benefit that we're getting from the SSSG of old stores.
margin.
Okay, understood. And my second question is, like, when I look at the region and check for the titles of
The consultancy EBITDA will be how much
I don't find
separately?
them. So is it like, okay,
25%?
all the management positions are held by very new joinees,
Okay.
or what's the
Profit is
situation?
28% in this
No, so most of the management position is in fact held by old people who have been promoted from within the organization. So our retail head is a person who was a floor manager in one of our stores about 13 years back. Our business development head was a store manager. All our regional managers have also, been promoted from within the organization. The buying and merchandising head used to be a subdivision head.
Including both trunking
So all the positions have been filled by people from within the organization, and that is why, other people in the organization see that if, you work hard and you achieve the targets and you follow the company culture, there is such a big room for growth. And that's a very good career path for all the employees here.
39 crore, 38.
So who is the CTO, by the way?
So the CTO's name is Anupam, and there's a team, so our SAP,
Thank you.
so there's not a CTO, so there's an SAP
The next
head,
question is
there's
from
an
the line
applications
of
head,
Samarth
and there's
Khandelwal
the
from
person who
ICICI
takes care of the POS.
Proceed.
So that is how we have divided the IT department.
Thank you for this opportunity. Sir, could you share some color on how our order inflow trajectory is from
It's about the structure of the department.
international market? Okay, it will be very good if you can just show the structure in your investor presentation.
As of now,
Because that is creating a lot of noise around.
1,000 crores.
Yeah.
Sure.
Of which approximately around 15 or 1,800 crores is from
Thank you.
the segment.
The next question is from the line of Samartha Nagpal from Sudhanu Family Office. Please go ahead.
1,380 crores.
I thank you for the opportunity. Congratulations on Akash on a great set.
Going forward, how do you
just wanted to go, so most of the questions have been answered. Just wanted to know that as we are scaling very rapidly, how much of an issue is finding the right manpower in tier 3, tier 4 cities, and how much of an attrition is a problem? So just trying to understand in value
do we see more opportunities conventional versus the domestic, or how is it balanced from both the
sides? So just wanted some
color. We have a lot of opportunities. We have focused.
Yeah, so for every new store, the additional manpower required is of course the manpower that you keep at the store, because the head office and warehousing, they can be leveraged. The existing manpower can be leveraged for the additional stores. But because most of our store staff is at minimum wage, the attrition at store level is quite high. It's I think around 40-50%, because they jump ships even with a 500 or 1,000 rupee difference. So what we have done is we have completely moved away from being manpower oriented to being process oriented. So we've automated a lot of processes at our store, where even a new guy within a day or two he can get trained and he can start giving an output. So we are not relying on any of our store manpower for using his intellect or using his brain to display particular design, display a particular color. So everything is handled through technology and the fitness that you're giving at the store.
We will be again
and for the core positions like store managers, store managers, so all of them have retention bonuses. And because our sales are good, so a big chunk of our manpower salary is variable salary. So if they are achieving their targets, they get anywhere between 10% of their salary to about 35-40% of their salary. So that has also really improved attrition numbers, because people are seeing that, because in more than 90% of the locations, our sales are at least 40-50% higher than our closest competitors. So people are seeing that none of the other retailers are achieving their targets, and V2 stores are achieving their targets, so they're getting a lot of incentives also. So that is really helping us.
That will come into the company.
So Akash, on the second thing, I think we are all set for the next 2 years as we have laid down the expansion plan.
As of now, there is, one can understand that whatever 491 crores we have invested, that is the equity as we hold in our income market. There is no return as of now till they start releasing out any cash. That is what the expectation is.
As of now.
Whatever loss in R&D.
We don't have any franchising plans. Because we don't have a very good experience with franchising, and it actually dilutes the store experience and the brand experience for the customer. It's very hard to standardize that when someone else is handling the store. So we are not exploring that.
Or they are only
correct. And on the mental wear part, I think
so that is what my question is. Other than that, this is only a book entry. It has no other reference.
Or do we see that we haven't done enough of buying and there will be certain gaps coming up? So just wanted some color on that.
In case it will permanent loss.
So I think it's a very good problem to have. So definitely there have been some shortages, but I think it's a very good problem to have, and we look forward to always having this kind of problem where your sales are better than your estimate, and there is a little bit of stock shortages. So our team has gone to different cities in India to find out if their ready stock is available, and we are buying a lot of inventory from our vendors, so they in their brands to cover up for the shortage.
Thank you.
Got it. Understood. And one final question.
We take the next question from the line of Anupam Goswami from Third Line. Please proceed.
Call out for a CEO as well. So are we looking to beef up the organization and hire a CEO as well? Then what would be your some color in that direction?
In the near term?
Yes, so the kind of growth trajectory we are on, we are always on the lookout for good people. And me and my father both, we want to hire a CEO, so that we can spend more time in the long-term strategy of the business. Because the plan is big and we want to, grow multiple times and exponentially over the next 10 years. So of course, if we find a capable person to take care of the day-to-day operations and the running of the business, then we can move on to a more, I would say, strategic role.
Understood. I think that's it from my end.
They're also investing, they're thinking of
Thank you.
Petchem project there. It is around
Thank you. The next question is from the line of Hitendra Pradhan from Maximal Capital. Please go ahead.
1.25 crores.
Hi, sir.
There are a lot of opportunities are there.
Yes, sir. You're audible.
Studies have been done in past,
the SSG
those are still under consideration with the clients. So if they get materialized, let's hope for the best. It should be implemented. Also, there has been some issues with respect to the
it will be different because it's open to interpretation and different people use different number of days to calculate the impact. But what we have done is we've taken the 30 days before the Shera and we've shifted those 30 days and compared it to the same period last year. So I think the correct number to compare all retailers would be to see the weighted average SSSG for the 2 quarters combined. So that will give a standardized number to compare SSSG between retailers. But if you want to just look at 1 quarter, I think it's very hard to compare because some people might have only taken 5 days before the festival.
My first question is
so that reduces the difference by quite a lot.
There will be a dilution on the consultancy margin due to rising international mix. Or is it fair to expect that we will maintain that band of more 20 to 25%
the new
margin
mix will also change?
On overall basis in the domestic as well as international purchase.
That becomes more complex because then you have to calculate the number of stores, number of days that these stores were opened in the last quarter. Then you compare only those days. So we don't want to change our SSSG calculation cohort. So it's always stores that were present at the end of the last financial year. We calculate SSSG on those stores.
Fair, sir. And my second question is related to your outlook. You mentioned that you are targeting 20% plus ROE, beyond when the expansion and the growth plans are executed. So, sir, on ROC basis, how do you see the mix evolving and what are the challenges that you foresee in achieving, let's say, 20% ROE, 25% ROC?
It should be towards the end of this financial year or the early next year. The study is on study, we are doing it. So that at this point of time, we are deciding the
competition coming in the physical space.
Studies have been on.
So, sir, what
so
are
by the end of
the
that study,
drivers
they will
that
take a decision and take the management
let you achieve the ROCE or ROE of more than 20%?
So it should happen towards the end of this financial year or early next
FY 28.
Understood, sir. So I think it's all about the correct execution again. Like if we have built a strong model, our ROE last year was around 27% on the pre-Ind-AS basis.
Please proceed.
So that means we have established a very, very strong model, and if we continue continue working on the product, continue using data to come out with the right assortment,
what would be the opportunity?
I think there's a lot of potential in the country. We can easily have 2,000 to 2,500 V2 stores. So getting ROE is all about making your model strong and replicating it and giving the customer the best experience.
But these are the staggered opportunities. They are not coming in one way because it's a large investment. Many of the projects will come in the phases. So
thank you. The next question is from the line of Ashish Soni from Family Office. Please go ahead.
Okay. So, sir, my understanding is that, for these projects, whatever is of the construction, we are handling mostly the consultancy part, or when we take up the turnkey, how are we bidding for that, sir?
No, any of the projects.
So, last year we were working with around 180 to 190 vendors. Now we have increased that to almost 250 vendors, and we have a list of almost 500 vendors who are willing to work with us, who want to work with us, but we are waiting for our volumes to increase to use the capacity. So in terms of manufacturing capacity, we have the outlook or the visibility for the next few years. So in terms of availability and sourcing, so we plan a season at least 4 to 5 months before that season. So for example, this winter, current winter season that is going on, we had closed the orders back in May and June. So we had already planned for all the stores that we wanted to open. So all the stores are very well fulfilled. The only stock shortages that are happening because The sales are
Can we
better than
get a guidance on like what would be the thumb rule for say some percentage figure of the total cost of the project?
So it all depends in which mode it is being executed. It could be if it is a large budget, it could be 2-3%. Our service could be 1 or 2%, 3%.
What do you want to understand about the internal management structure?
Overall costs which are available in the market. It's if you talk about 1 lakh crore of the project, it's not actually complete the cost on which we'll be getting the consultancy. We'll be getting the consultancy services on the base, on the plant and machinery cost. So if you see the overall.
So again, see, there are two things. Because when you're expanding this fast, the most pressure that comes is on the new store opening department, the business development department.
Thank you.
So for example, our business development department used to be just 4 people. Now there are 18 people in that department. The new store opening team used to be just 3 people. Now there are 21 people in that department. Retail operations, we used to just have 4 regional heads. Now there are 8 regional heads. So definitely you need to keep adding more manpower because you are adding so many new stores.
On behalf of DAM Capital
Again, for the next 3 to 5 years, because of the trajectory we are on and where we want to be, we are again looking for more people.
Ladies and gentlemen,
of course, every good organization needs good manpower in order to grow.
FY26 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity.
Again, it all depends on the execution and the performance. If our performance is as strong as it has been and the growth is strong, then we will increase our store opening target. But right now, looking at the cash flows, we are covered till the end of FY28.
I now hand the conference over to Ms. Bhumika Nair. Thank you, and over to you, ma'am.
Hi, good evening, everyone. On behalf of DAM Capital, I welcome you to the Q2 FY26 earnings call.
See, there are 2-3 different types of risks in this business. So the biggest risk is inventory risk. So that is why we have a lot of checks and balances around aging of inventory management. So I think no other retailer puts their slow movers on discount within 2 weeks of introduction. So we have been able to get our more than 1-year-old inventory from about 24% to less than 4% now. So inventory management is the most important, I think, tool or the area of focus for any retailer. So that is one of the biggest risks where you get a complete season's assortment wrong. So that is why we believe in using a lot of data. We use data to design almost 60 to 70% of our new season's assortment. So if my data is telling me that cream color is the hottest selling color, then we will introduce more designs in cream color. So similarly, this is done at all article attribute level. The third risk is you finalize a wrong location where there is no footfall and it's in a locality where the sales potential is not that much. So again, there we have 4 to 5 layers of checks where the area manager goes and checks first, then the regional manager, then the retail head signs off on the project, the business development head signs on the project. And then we have a core business committee that signs on each and every site that we finalize. So these are the main risks, but again, we've learned from our mistakes before, and that is why we build checks and balances around these risks so that we don't repeat them.
On 14th November 2025.
Okay, thanks and all the best for the
As regards to financial performance for 3 months ended September 25.
Thank you. The next question is from the line of Rajesh from GNMA Venture. Please go ahead.
Rupees 676 crores.
Good afternoon, gentlemen. Akash, congratulations on a very strong second quarter numbers. First profitable second quarter. The growth construct seems to be pretty much in place given the perfected business strategy that you have worked on over the last many years. 10%, 8 to 10% SSG, and close to 35 to 40% store square feet. Is that the right way to look at the growth construct for the next few years?
79 crores respectively.
No, so if you want to grow revenue by 50%, so 8 to 10% will come from SSSG and 40% revenue will come from new stores. But to get 40% revenue from new stores, you need to add 60 to 70% new area. Because new stores do about 70% of old stores PSF.
September 25 stood at rupees
Right. Yeah. Okay. I got it. You are right. Absolutely. And given this massive, significant expansion in the growth, one part of the equation is that would you continue to keep gross margin at the level where you are as a strategy design? Given the benefits of the operating leverage and the growth, you will continue to invest in new stores and keep the margins intact? Or will you pass it on to the customer?
160 crore. EBITDA margin.
So our target gross margin is always 28-29%. We want to pass on everything to the consumer because we feel it is the time to get the maximum market share and the maximum per square feet sales. So we would always prefer having a higher per square feet sale to get more EBITDA margin rather than a higher gross margin. Because when you have a higher sales per square feet, then your inventory freshness is better. Then you just have a lot more margin to play with.
Consultancy and engineering segment amounting to rupees 890 crores.
Okay. And the point is, what is the biggest challenge to you and your dad in this journey of you? At the beginning of the opening remarks, you mentioned that design team is core. And the other team is also core. So, when you run at such a high speed, obviously, the software aspect, building culture, maintaining culture becomes the biggest challenge, and there are no set formulas for this. So how are you handling this